Hello, this is David Jensen with your June 14, 2023 Economic and Markets Update. The title of today's discussion is Silver Price Discovery, Fraud. Okay, if you like this presentation, please do give this video a thumbs up. And these four platforms are the social media sites at which I post my information. A quick update here, a recap of the October 31 presentation. The Bank of England gold price rig now leads to global collapse. This presentation presented the information of how the Bank of England was given oversight and authority over the London gold and silver market under the UK's 1986 Big Bang financial legislation. Why it's important for gold and silver is that this is the world's largest physical gold and silver market. In 2016, they were 88% of the daily global gold trading turnover. And what this legislation did, it allowed the Bank of England to implement oversight of the market and switch the market from a physical trading market where they were trading physical bars of gold and silver into what's called an unallocated spot contract market. Now, so unallocated means there's nothing specifically allocated to each spot contract, and that there's only a promise to deliver metal if the metal is demanded. But keep in mind, the spot contract is an immediate ownership market, and what that allows ultimately is several times annual mine supply to be sitting there in the market in a paper form as a demand for metal without actually having the metal there. So the net consequence of that was that because gold and silver are the inflation warning systems, the price inflation warning systems from when the central bankers, the money printers, print too much money, in essence, the price was rigged by causing a decline in actual physical gold and silver demand, and shutting down the price signal that would come from the trading of these assets. Now, because they're a warning system of a debt bubble or a overprinting of money by the central banks, because we have a debt-based money system, overprinting of money results in too much debt. We ended up with a global debt bubble that has existed since the late 80s at an increasing level, and it brings us to the point we're at today. Okay, look at the silver vault holdings in the New York COMEX vaults. Now, first of all, this chart's produced by Michael Lynch. He posts under the handle Ditch the Deep State on Reddit. And thanks to Michael for producing these excellent charts. So what we're looking at here is the vaults in New York under the registered silver category. So registered silver is the metal that is available for market delivery on the commodities exchange that's in New York. The registered vault holdings, they rose in 2020 up to about 152 million ounces. And now they've declined down. This is a graph that ends at the beginning of June, but today, on June 12th, the amount of metal that was in the registered category for delivery was 27 million ounces, so a little bit lower than is shown there. And what that is indicating to us is that the high physical demand that we know has existed since early 2021 has continually drawn down the metal that's available for the traders to make delivery in New York, and that the physical silver market is now stressed. Okay, what I've done here is superimpose two graphs. I hope you can see this clearly, but this yellow-white line here is the price starting 5 years ago, mid-2018. And in behind is the implied lease rate. Now, the lease rate is the cost to borrow metal when the traders have to deliver metal in the paper markets. What its value, it's an implied lease rate. It's not the actual lease rate, so it tends to be 1 to 2% lower than the actual lease rate in London. But there is a general correlation there. And what we're seeing here is that, that there has been an increase in the lease rate. It dipped first in 2020 during the COVID panic, and then it has increased back to the zero level where it existed for long periods of time, and then it's climbed up to about the 3% level over the last year, roughly, in between 2 and 3% there on the 2-month tenor for a 2-month lease of metal. Now, what we're seeing here, a couple of things. Specifically, the most obvious thing is that as the lease rate started to rise from the beginning of 2022, as the physical shortage started to show itself in the market, the lease rate, the 2-month tenor, you can see the red line there, rose, showing there was a shortage in the market. And at the same time, the price dropped from $26 to $18 per ounce. So fair trading markets don't do that. When there's a shortage of metal, the price rises, and when there's a surplus of metal, the price falls. And what we can see here is that since early 2022, there's been zero net change here in the price of silver, despite the fact that the lease rate here has risen to quite a high level of 3%. And we'll see on the next slide context for that. What this is an indication of here is, just a final note here, is this false price discovery. You don't have a falling price while you have a metal shortage in the market. Okay, so looking back now, back to 2008. Now this is a graph from June 2022. And the reason I'm using this is it gives us a look back in time, back to 2008. And you can see there that the price spiked slightly above, or sorry, the lease rate, the implied lease rate spiked slightly above 3% there back then, and then declined slowly in time. But that this rise of the lease rate, indicating a market shortage, had a muted effect on the market. It took several years, or two and a half years roughly, for the price rise from roughly $8 up to $48. That's a 6 times price increase. What we've seen going back to this slide here, we see that we're in roughly the 2 to 3% range there, and that range is the range that was violated back then in 2008, that led to the rise in the silver price thereafter. Keep in mind here that since 2020, 2020 saw a market deficit of 275 million ounces, but there's been a steady market deficit of roughly 100 million ounces per year in silver. And it's this accumulated annual deficit that has led to this high lease rate, as it's finally dried out the market here, and we're seeing a shortage of metal. The problem that we have here is that this is a paper market, and that the paper market is muting the movement in the silver price as a response to the market shortage. The next point I'd just like to review here is this slide presentation from February 2023, and that dealt with the fact that the silver price had a manufactured aspect to it that reflected the fact that it's merely an algorithmic price setting tool, and again that there's been a divorce from supply demand factors in the market and setting the price. And what the presentation found, that when you take the gold price and raise it to the power of 2.5 and then compare it to the daily silver price, when you compare those two graphs on a overlay, what you're seeing is that there's almost a perfect correlation for more than 6 months at a time in some cases. So these are two very, very different markets. Silver has a 50% industrial demand plus other physical demands, and has much less metal available to market in terms of stockpiles versus the annual demand numbers. So when we look at the vault numbers, there's round numbers, 50 to 75% of annual demand is in visible bar stock in the various exchanges, and versus gold, in which there's multiple times the annual demand. And there's no way that that silver should trade in lockstep with gold in terms of the price action, given the very different characteristics that these metals have. Just looking back from March to September 2022, we saw that this perfect correlation here between gold price raised to power 2.5 versus silver. So there you have your algorithmic trading of the metal and a divorce from the supply demand, which is supposed to be driving the market. And then from September 8th to the 16th, there was a short period there where there was a break in this correlation. And now if we go to the next slide, we can see here that from September 16th to January 1st, 2023, they went back into correlation. So there was just roughly a week period in here where that trading correlation disappeared, and then it was back again from September 16th through to the beginning of this year, 2023. At that point, silver flatlined in price in terms of its price activity, the price action, and gold traveled up. But let's look at what's happened from the end of January. So we see here from roughly January 26th, there's a break there from January 1 to January 26th, and then we look from January 26th through to today, and we can see again more proof that there's an algorithmic maintenance of the price activity between these two metals. We know from the market structure that it's a paper trading market. It's driven by sentiment, and that sentiment is set by the price action versus the actual supply demand. Now, going back to 2016, we had a similar situation where the lease rate started to spike in palladium. And what that forced was these bullion bank traders were squeezed out of their price maintenance for palladium in the London market, and the price moved 5 times over the next 24 months. We're getting to the point now where the bullion bank silver traders, with central bank oversight, are being squeezed in a similar fashion. It's a question of how long they can maintain this price action, given the fixed amount of metal that's in the market, and the fact that we're now into a situation where there's the supply deficit is built up now for 4 years and running, and the excess stockpiles have been bled off, and the lease rate is spiking because of a lack of metal availability. So I'm expecting the bullion banks are going to have to step out of the market immediately or face default by offering their silver paper contracts into the market on a continuing basis. They can't continue with this pattern of action. A closing thought here. As we end 110 years of monetary central planning, the central planners always bring chaos, and we're at this situation again, and encouraging the people to think about securing actual physical metal, and be aware that the containment of interest rates has been maintained by rigging the gold and silver price for decades. And at some point, they're going to have to back away from this maintenance scheme, and you're going to see interest rates soar and consequences vest from this rigging scheme that's been in place for several decades. Okay, thank you for your time. Once again, these are the social media platforms where I post my information, and I look forward to talking to you again soon.